No surprise to see such little movement in markets on this Thursday, July 4th, with the trend-setting U.S. market close for holiday. The U.S. dollar index sits right around the 200-day moving average into the second half of 2019, and this is after trading below the longer-term indicator in late June for the first time since mid-2018. The index had rallied back above the 200-day on the news of the renewed trade talks between the U.S. and China earlier this week, though, as we've cautioned, we do not believe the market should be taking this development as a sign of the U.S. withdrawing from its soft dollar protectionist policy campaign. President Trump's latest tweet on the matter highlights this fact after accusing China and Europe of playing a big currency manipulation game that he said the U.S. should match. Technically speaking, it isn't uncommon to see a market cross back above a 200-day moving average after crossing below it for the first time in a long time, and the move is classified more as a minor correction after a strong bearish signal of the break below the 200-day, with a lower top sought out ahead of the next major downside extension in the dollar index. As far as the index components go, the jump in demand has come from strength against the euro and pound, though at the same time, an impressive run in the Canadian dollar this week to fresh 2019 highs against the buck and ongoing demand for the yen have been offsetting demand for the index into the recovery rally. Overall, we see U.S. administration soft dollar policy, those comments that the ECB isn't looking to take additional action at the upcoming meeting, and some efforts from the leading Tory candidates to reassure a no-deal Brexit will be averted as stories that will once again fuel demand for the euro and pound into the latest setbacks against the dollar and get that U.S. dollar index trading down well back below the 200-day moving average as the dollar starts to trend lower after already enjoying a very nice run in recent years. Over on the equity side, stocks continue to play the game central banks and governments have been pushing, which is the game of buying at every turn on the reckless incentives from ongoing excessive policy accommodation and stimulus. Despite exhausted efforts, U.S. equities are at record highs, but all of this feels less than credible, with the moves more about the incentive and less about valuation. We believe this leaves risk assets highly exposed to any negative shocks to the global economy going forward, and we think the Fed will be needing to take its responsibility to protect against financial stability risk more seriously. One of the markets that has been red flagging these dangers in recent weeks has been the gold market, with the yellow metal finally breaking out to the top side after being suppressed since the 2008 crisis. We think this is a warning sign of a major capitulation ahead in U.S. and global equities that could play out in the second half of 2019. That's all for now.